Hello and welcome to Market Sense. I'm Catherine Murray and I'm joined by my co-hosts Andrew McCreath and Randy Cass.
Today on the show, market strategy with Jerome Haas from Lightwater Partners. And as the Facebook Roadshow kicks off, we'll talk with a new Pam Pellet, analyst at Greencrest Capital.
But first, some stories moving the markets. Elections in France swept Francois Hollande to power over Nicolas Sarkozy. European shares ended the day higher as fears over government austerity plans proved short-lived. I think that one of the big key takeaways here is how and why did the European markets close higher? Because a lot of this was already known and priced into the market. Sandra, what do you think?
Well, I think there's also some news out of Spain where there's a belief that the government is going to deliver a policy by Thursday that's going to help bail out the Spanish banks, because the fact that European markets closed up 1.5% seems a little ludicrous to me, given what's going on. So if I look for trying to find an answer, that can be the only thing that I think of, even though it makes no sense either, because the Spanish government doesn't have the money to bail out its banks.
Right, so shame on us as investors if we're getting fooled by talk again, that we have a solution, it's on the come, it'll be here in about 48 hours, shame on us. We've heard this time and time again, the solutions are never real solutions, they're just band-aids. What I think another potential reason, Andrew, is that we've learned that when things get really bad, and make no mistake, they got really bad in Europe this week. And I mean, France, Hollande, that was kind of anticipated. What happened in Greece was a disaster. Like, they don't even have a government right now. They have a bond repayment coming next week. They don't have a government. They don't know how they're going to do this. And we know in those situations, throw money at the problem. Throw trillions at the problem. And when you do that, the markets rally. So why not get ahead of it?
And we've talked before that I certainly think it's inevitable that Greece will default again. Mm-hmm. There's a twist this time, because who's long Greek bonds? But the European Union. But
you guys, the difference this year versus last year, and MKM actually wrote about this and the fact that they don't think it's going to be a three-peat, meaning 2012 will in fact be different from 2010 and 2011.
It'll be worse.
Well, no, actually they think it's going to be better.
Because it could be different worse too, right?
That's a good point, but they actually say it's going to be different better because a lot of these knowns are already known and in the marketplace and priced in. But the other aspect that's different as well is, think about last year. We were in a situation of a liquidity crunch that would be felt around the globe. That's different. Now it's more of a growth concern.
I'm not sure it's a growth concern, because the liquidity solution is only a temporary solution, and that Band-Aid is coming up, right? We know that people are already seeing yield spreads on the banks that took the LTROs are much higher than the ones that didn't. In short, that means they're looking at banks that needed liquidity kind of coverage as unhealthy. So I'm not sure we're as far past as you think we are.
I hear what you're saying, but I do think that the market is reflecting that we're a little bit further past than where we were a year ago. But another item that we're looking at today, another story making headlines, is Facebook's Roadshow, which kicked off in New York City today. The company is expected to issue shares on May the 18th. So a lot of focus here, in part because of a market sentiment in terms of how much demand there's going to be for this deal. It gives a bit of an indication to the overall market sentiment. Andrew, what do you think?
I really like the commentary the Wall Street Journal had today with respect to Facebook and his Heard in the Street column. It basically said, sit on the sidelines for the IPO. I know Randy's talked it many times. Don't buy these hyped up internet IPOs on the day they start trading. Wait for them to fall. That's what the Wall Street Journal says too. I think there's little question Facebook has a solid business model, unlike a bunch of other of these companies that have gone public in the last 6 months. But I think that the stock is set up to fall once the halo's gone after the IPO starts trading.
I mean, if you're fortunate enough to be able to have some allocation on the IPO deal, if some broker somewhere owes you a favor and they're giving you some shares, take them, because they will make sure that this thing has a pop on the open. It'll be a failure if it doesn't, but don't buy it on the pop. And Facebook does have a business model. This isn't Zynga, this isn't Groupon, this isn't one of those other ones that came too early. It does have a business model. The problem is we don't know how much are sustainable of a business model, right? It's at $4 billion in revenue, $1 billion in earnings. Those are great numbers, but it's a $100 billion IPO hypothetically on day one. That is really, really expensive.
Well, and so that's what it really comes down to. It comes down to, what do you want to pay for this? And that's what the investors are going to be figuring out over the next 2 weeks during the roadshow.
And we're going to have someone on to talk about the roadshow as a starting point going forward. But what we know from the roadshow today, Zuckerberg got up on stage and said, 8 years ago, you told me this. I was using, our producer told me this. I was using Google. I was using these search engines that we are now ahead of. That might have been a bit of boastfulness, but it's also a bit of a warning that in such a short period of time, the industry can change so much. $100 billion warning, perhaps.
There's going to be lots of great stuff on the internet about the roadshows this week, the stories that get told, and of course, Mark Zuckerberg showed up in his hoodie. No suit for him.
Very different from the past. All right, and lastly, the Ontario Teachers' Pension Plan is backing activist investor Bill Ackman in his plan for management changes at Canadian Pacific Railway. So one more vote of confidence, really, for this change or potential change at CP. Randy, what's your take here?
Yeah, CP, stick a fork in you. You're done. I mean, this is
why? Because the stock's already run so much.
No, it's not the stock.
It's
It's the management and the board. You're done. Ackman's won. Pershing Square's won. Like this is done. It's over right now. You got to get on the phone. You got to try and save some face. You got to try and come halfway, because when this vote happens, teachers is not someone whose opinion is taken lightly in this industry. They don't own a lot of you, but for them to go on the record and publicly say that they agree with the activists, that's not something they often do. You're done.
And I have to say, you know, certainly they're obviously very, very well known in Canada, but they're also actually very well known and respected in the States as well. When I speak to my institutional clients or former clients.
Teachers, yeah, absolutely.
100%.
Look, they hire talent like me.
They did hire you.
I started there. It's an incredible soft.
I mean, it's just like TELUS is going to the number of potential voters that actually shows up to vote is going to be very important in assessing who wins this battle and the TELUS battle.
I guess the question comes down to as well, though. I mean, we just brought up the stock chart. So, you know, if in fact you get a change in management, change in board, where does the stock go from here? Are we already seeing it reflected in terms of the potential here?
I think we are.
Yeah, I mean, there's a lot of value that's been built into the stock since this process began. I guess Teacher's point and Ackman's point is that we can generate more value, and no one is quite believing Green and CP's current management that they created the stock value, and they have better operating ratios now than they did before, no doubt. But there's a lot of companies out there with better operating ratios, and they're saying we can take this further from here right now.
Right, but again, a lot of that is built into the share price. This is going to be a buy on rumor, sell on news.
And
so when the stock pops after he wins the vote, sell your stock.
So then, and ultimately, a show me stock.
Absolutely.
If you have questions on the markets, you can email us at marketsense@bnn.ca, or you can tweet us at marketsensebnn. And when we return, we'll take a look at some long-short pair trades that could pay off in the near future. Stay with us. As earnings season wraps up, the number of companies meeting and beating expectations haven't been very strong. Our next guest feels that in light of the weaker than expected earnings, investors need to rein in their exposure and reduce their risk profile. Joining us for today's Trade Talk is Jerome Haas, partner at Lightwater Partners. Thank you so much for joining us today.
Thank you.
And, you know, I think what we should do is probably get right into your trades here, because you do think that there's some concern in terms of going forward, where the earnings have been and where they're going for the rest of the year. What are you saying in terms of some of these picks here, Leon's in particular?
Sure. Well, firstly, we tend to focus on the mid-cap space. So in the media, there tends to be a lot of focus on the large cap, but we often think there's a disconnect between what's happening in the mid-cap areas and in the large cap. And we saw that particularly in 2011. So what we wanted to bring in was two examples of trades that we have. One is one that's driven by the long side, another one that's driven by the short side. So the first trade is the BRIC versus Leon's. And those are, I'm sure most of your viewers are familiar with the two companies. They're pretty tightly paired. The big difference between the two is that the BRIC nearly blew up in the last downturn in 2008 and 2009, and it had to be rescued by its founder, Bill Comrie, as well as Fairfax. And so essentially what they're doing now is unwinding that trade that they needed to rescue themselves in 2009. We like the Leon's. We think it's a well-managed company. It's just a question of mitigating some of our risks. And we do think that on a valuation basis that the BRIC is much, much cheaper than Leon still.
Jerome, we had a chart up, and I don't know if we can bring it up again, but it had both the BRIC and Leon's on it. One, when did you get into this trade? And two, can you maybe explain briefly for the viewers how you make money on a spread trade like this?
Okay, well, we actually started in the BRIC 2 years ago in the trade. What we did was we went long the warrants and short the underlying stock. And the reason for that is you get more leverage out of the warrant than you do in the underlying. So you're facing the same company but you don't have the same level of risk in terms of performance.
All right, let's get to the brick versus Leon's. That
Sure.
might be an easier example.
So we put that on in last summer when the warrants converted. There was a cashless conversion of that. So we were concerned about the liquidity in the warrants. We switched into the underlying common, and we hedged our position in the brick against the Leon. So we're long brick, short Leons in that trade. And essentially what we're trying to do is see a narrowing in the valuation differential between the two.
That trade's worked marvelously. What about going forward, now that the brick has restructured, is profitable, has, I think, paid off the Fairfax debt?
It's not entirely out of that. They still have some of that expensive debt that's left. And the question is, when they do have this cash that they'll be sitting on, how do they spend that? We see a dividend coming in the future.
What about the fact, though, that the furniture industry has not been as strong, perhaps, as need be to move these stocks higher from here? I mean, how does that play into? You'd think that it would be a little bit stronger.
Well, again, we're protecting ourselves because they're quite tightly matched. So Leon's will generally perform in line with the brick, but we happen to think that the brick is gaining market share over Leon's and in terms of their competitors in Quebec, which is Bro and Martineau.
Right. Well, one of the reasons you would do a trade like this is because you like the fundamentals of the brick. You might not like the fundamentals of the furniture industry as a whole, so you find another furniture store to go short against the fundamentals of the brick, right?
Exactly. That's how we mitigate our risk. And that's one example of a pair trade driven by the long side.
Do you have another sector-neutral pair trade that you can talk to?
Sure, and this trade is one that's driven again by the short side. So we were short Air Transat and we wanted to mitigate our exposure against that. So we looked at a number of names in the aerospace and airline industry, and quite frankly, we don't like the industry long term, but we wanted to mitigate our risks. So we put a long position on WestJet against that. And the idea being that if jet fuel prices rise, it will affect both of them. But we think that just in the long term, we have a lot of negatives against Air Transat. Largely, it's thin margins that it has in the best of times.
All right, so same questions. When did you initiate that pair? And then the fundamental reasons are because you dislike Transat. Is there anything you like about WestJet, or was it just a proxy for the airline industry?
It was more a proxy for the airline industry. I mean, WestJet just came out with some numbers. They were good numbers, but to be honest, it was more just risk mitigation rather than looking at WestJet per se.
How does the decline in the price of oil affect these trade ideas?
Well, both of them are quite sensitive in terms of jet fuel prices, and that's one of the concerns with the trade. So when Transat got close to $5, we started to unwind part of that trade. It probably has more leverage to a lower jet fuel price and oil prices than WestJet, so it's a trade that we're more likely to wind as it gets closer to $5. The other thing that's a reason to exit the trade is the cash value of Air Transat, which is arguably around $5.
Another airlines, I'm in agreement with you, Jerome, that the airline business is not a good business to be in. Another stock that's had a real rough go of it is Air Canada. But it is not wise, or I should say it's highly risky to short a security that is below $2, $1.50. Would you agree with that? And if so, why?
Well, it's because of the borrowing cost is one thing. So typically, even though the stock, in Air Canada's case, maybe...
So when you short a stock, you have to borrow the stock from an investment dealer, right?
Exactly. And typically, they use a minimum price of $3. So in the case of Air Canada, even though the share price is less than $1, you're actually paying a rate as if it was $3. So it tends to be a more expensive borrow.
And that rate is a percentage of the stock price when you borrow it. So if they judge it at $3, but it's only a $2 stock, you're right, you're paying a much higher percentage.
Yeah.
And you're paying a percentage, but it's a much higher penny price.
Exactly.
It would strike me also that the risk of the stock going up on you is much more than the potential for it to go down that much more because it's such a low price security anyway.
Sure, and this is one of the big risks that you face when you're short selling is when things go well, it can be very painful for short sellers.
All right, we have maybe 30 seconds left. Do you have a non-pair trade you want to touch on?
Sure. One of our core conservative names is Temple REIT. We like this because it's a conservative way to play the Western Canada resource boom. It's got an 8% yield on it. It has half the hotels in Fort McMurray. It's basically a play on small cities and towns in Western Canada. It's uncovered by the street. And we think it's going to grow its net operating income by 50% this year. On top of that, it's trading at a discount to its NAV, net asset value, of about 17%.
How much is this correlated to commodity prices, though?
It's relatively uncorrelated because there's been huge sunk costs in places like Fort McMurray. It's going to take quite a bit of decline in oil prices before people abandon Fort McMurray. So we think it's got pretty solid fundamentals.
All right, Jerome, thank you so much for joining us today.
Thanks very much for having me.
Jerome Haas, partner at Lightwater Partners. And up next, how much is the deterioration in macro data hurting the markets? And are we in for a further sell-off? That is up right after the break.
Last week, I was tweeted by Jameson McCauley at Randy_Cash. You should follow that at Randy_Cash. He thought the Economic Surprise Index would make a good topic for Ahead of the Curve. Well, ye ask, and ye shall receive, Jameson. So here we go. Let's start with the basics. What is the Economic Surprise Index? Definition behind me is going to tell you it's a measure of how economic releases are doing against expectations. We all have expectations about where we think numbers are going to come out. The more positive surprises there are, the higher up it goes. The more negative surprises, the further down it falls. We measure it over a 3-month rolling window. It's measured daily. Now, there are a few of these indices. The one behind me is a UBS index. But let's focus on the city one, because the city one, the next one that's coming up, is the one that's followed by most people. And you can see that both of these at the end of that index and on this one are rolling over again. Well, what does that mean for the markets? A lot of people feel that it means we're heading down. But when I ran a graph trying to correlate the turn in the Economic Surprise Index with the S&P 500, you can see that there was actually no correlation at all. The red line is the S&P 500, the blue line is the Economic Surprise Index. But that was until I ran a shorter graph. And you can see this one just measures the returns from 2008 until present day. All of a sudden, there's a bit more of a correlation. When the Surprise Index begins to turn up, the S&P 500 follows. When it begins to turn down, as it did in the middle of 2010 there, the S&P 500 rolls over, and you can see the rally began. It was preceded by the Economic Surprise Index about halfway through 2008 and picked up by the S&P 500 in 2009. Why the difference? Well, I think between 2002 and 2008, we were living in a stock fundamental world. How the stocks did dictated how our markets did, and they did pretty well. From the crisis, though, in 2008 until now, it's a macro world. We care about Europe, we care about the economy. Everything tends to be driven by the same macro headwinds or tailwinds. What is it now? It's still a macro world. That means that when this indicator looks and turns over, we need to take heed and look out below. That's how you get ahead of the curve. Let's take a look at what stocks are moving markets today.
Randy's talking about the macro world, but I also think there's a few company specifics that are also driving the markets higher. Let's take a look at Jamba Juice today. They just reported their numbers after the close, and they certainly beat expectations, both on the bottom line. They came in with about a 3-cent loss versus 6 cents expectations, 6 cents loss, that is. And the comps were so much higher than people were expecting. The comps were actually up 12%. Fourth quarter, they were up 4%, and that was even a surprise. Part of this, of course, is potentially driven by warmer weather. More people are going into Jamba Juice. This is where you can go in and order your own smoothie, the one of choice. But I think what's really interesting here, and the stock was trading up into this reporting period today, up about 3% or so. It's trading up higher even after that. But it's a real transition story, and that's why I want to bring it up. You can kind of take a look at some of these stocks, get a feel for what is going on there, and they are in fact transitioning to a little bit of a better story, more of this kind of healthy living style.
A lot of competition in that space.
Really? That's what you're thinking? I'm thinking no Jamba Juice.
Yeah.
I'm thinking we're talking of food. Where's my Jamba Juice?
Yeah, I noticed 12% comps in the quarter, but only they're forecasting 3% for the year.
Well, and I think that's because they are trying to be conservative, as every company in this in this particular space would be. But 12%, I mean, you guys have got to get a little bit excited about that.
I'd get excited if you delivered a Jamba Juice, but you didn't.
Thank you for coming on board.
What I was going to be delivering was wheatgrass for the both of you.
Well, speaking of transitions, there was a transition out of favor towards Inmet today. Ticker is IMN on the Toronto Exchange, down 8%, as the long-expected strategic partner for the company's Cobre Panama copper project in Latin America. There's no partner. The company announced that they're going to raise $1 billion in debt towards the $6.5 billion to develop this copper project. Investors gave that a thumbs down 8%. And this is definitely a sign of the times, because the strategic investors that everybody wants, their plates are full. There's no more of them out there. They got so many projects, they don't have the money.
All right, well, speaking about not having the money, it seems like consumers might not have it for video games going forward. Electronic Arts released their earnings after the bell, and they did what you hope they do. They beat on earnings, they beat a bit on revenue by a penny on earnings, but then they did what you're not supposed to do, and they lowered guidance for the upcoming year. This is a company that used to be the pinnacle of video games when video games were hot. I guess they might not be as hot anymore. And what they actually said is that with revenues coming down, this is an industry, they didn't say, this is my assumption, an industry in transition. You don't need the consoles anymore. You have the iPhones, guys. You play them on the iPads. When people are buying really complicated, well-done games for 99 cents a pop, it's hard to compete on the traditional model, and I think they're getting caught in that. Stock was down about 10% after hours.
Should RIM and Electronic Arts merge?
Yeah, titans of past successes. I wonder, let me think about who else we'll throw in there.
And what about, The Sims, right? That was supposed to be an internet game to compete with Farmville, even though I realize the game itself is different?
Yeah, The Sims was a huge, Sims 3, I remember, was the biggest launch ever in the PC video game industry, and they haven't been able to transition that to the little ones that we play, these ones right here.
Well, simple business certainly is donuts and coffee.
I do like donuts and coffee.
Tim Hortons, I just want to bring this stock up today because it did hit a 52-week high, 58.31. And I think one of the aspects that's important to point out is that you'll start to see a lot of different analysts come out and say, look, it's getting a little bit rich, it's getting a little bit expensive. I would say continue to stay with some of the stories here. You take a look at a Starbucks, a Chipotle, and a Tim Hortons, and they're all in the same camp. They've got brands, they've got growth opportunities, and they continue to deliver and execute. So as you hear chatter amongst the analyst community, still one that I think is a winner.
You know what they were able to do? They were able to pass along cost increases with barely a murmur from their customer base, clearly. I remember you walked in one day, they said, we're raising coffee prices by about a nickel. As long as you have Starbucks across the street and they're going for $4 a latte, there's a lot of room to increase coffee prices at Tim Hortons. So they have that elasticity. And that's good for them.
Absolutely, a real sign of the times. Another sign of the times is capital spending increases for mining companies. Thompson Creek Metals, they hurt their shareholders today. Stock down 16% after tabling lousy fourth quarter results last Friday. Deutsche Bank downgraded the stock from a hold to a sell today. The company turns around and raises some highly dilutive financing. A couple of $100 million in notes, in other words, a type of a debt instrument, but there was an equity sweetener attached to it. In other words, you buy this, we'll call it a bond from us, and you're also going to get a little bit of a play on the stock. But again, highly dilutive transaction, and the reason they had to do it is because when they released their fourth quarter results last week, they increased the capital spending forecast for one of their new mines by $350 million, a number that's equivalent to 50% of the market cap outstanding for this stock. This is a stock which is using $18 molybdenum prices in its modeling, even though the price of molybdenum is between $15 and $16. Get that for conservatism, is definitely a sell.
All right, so here's your rock, here's your hard place, and here's Thompson Creek right in the middle of it, right? They needed capital. They had no choice. They go do it. The stock gets hammered, and it's probably because exactly what you said, the Mount Milligan project. You don't know if they're going to raise costs again. You don't know if they're going to raise another few $100 million. And so not only do you dilute yourselves, solve your liquidity problem for the short term, but now you might have to do it again, and that scares investors.
Andrew, do you have a sense in terms of where investors' expectations and sentiment was on the stock prior to this?
Well, it's been on the down. It's been on the down for a long time now.
But how much of a surprise was this to some of the investors out there? Did anybody kind of sense that this
Well, the quote tells it all, down 16% today after the release on Friday. So this was definitely a negative surprise, Catherine.
Up next, Facebook kicked off its roadshow today. Is the hype enough to sell this stock? We're going to speak to an analyst right after the break.
When I was in middle school, I was using search engines like Google and Yahoo, and I just thought that they were the most amazing thing, right? It was this complete symbol of the age in which we live, where now you have access to all of this information. the thing that seemed like it was missing was always just people, right? So, I mean, the most interesting stuff that you cared about the most is actually what's going on in the lives of your friends or the people around you. And there wasn't really any way for that to be on the web. People had to share that themselves. That wasn't out there just ready to be indexed. So even from very early on when we were just building this thing for one school, there was this concept of what it could turn into. We just weren't sure then that we would be the ones who did it.
Well, he was the one to do it, and in a very big way. In 8 short years, he has beat out search engines Google and Yahoo that he was surfing in middle school to become the #1 site in the U.S. And today, Facebook founder Mark Zuckerberg is selling that dream to investors. The roadshow hit the pavement running today, and to discuss, we are joined by Anupam Pallett, Senior Managing Analyst for Greencrest Capital, who says there will be a day to buy Facebook, but it's not at the IPO, on the IPO day. Anupam, thank you so much for joining us. You do have a long-term hold, or you like this from a long-term holding perspective, but basically just be careful in terms of when you buy it. Don't necessarily step in on the first day if you don't already have the shares. Why is that? Why do you think it's such a good stock long-term?
Well, I do believe it's got a lot of compelling long-term value. You have to look at the company. It's an enormous company. It has really taken the market in terms of display advertising. It has a lot of revenue. It is profitable, which makes it very unique among a lot of the tech IPOs that we've seen. And I do think it will grow fast. But in terms of valuation, we're looking at the valuation in the $75 to $85 billion range. If it prices towards the high end of that range during the IPO roadshow, so 96, 97 billion, and it has an amazing first day of trading, which is typically the pattern, we would actually recommend investors step aside, wait for the valuations to come back down to earth before stepping into the stock.
Anupam, one of the things that struck me when we just saw that clip, and we mentioned it off the top, is that he talks about how when he was growing up, he played with Yahoo and Google. And clearly Google has succeeded and stayed around, but Yahoo is one of many that have joined the graveyard, so to speak, of former high flyers. How are you confident that Facebook isn't something that will be a transition, maybe a 5, 10, 15-year period, as opposed to a sustained long-term business?
It's a great question. You can never discount the possibility of competition. Facebook wasn't the first social network to get very big. They did to MySpace what MySpace did to Friendster, which is basically to replace them. What we like about the Facebook story is that they continue to invest in their platform. So they're not just taking their overall number of users, maintaining a static website and trying to sell advertising against it. They are trying to increase the overall service offering. They're trying to have more e-commerce services on the platform, video streaming services on the platform, different kinds of services on the platform. We think that constant investment in the platform is going to protect them over the long term.
All right, let me ask follow-up then. How long do they have to get mobile right, both on the revenue and user side, before they are in danger of being passed by the next mobile thing?
There's not a very big window here at all. They have to get it done very, very soon. They have been a little bit slow to mobile, admittedly, and they don't get a lot of revenue right now from advertising from mobile. So it has to be something that gets done very, very quickly. The first step is to really make sure the mobile app works very well. It is a little bit buggy, both in terms of the iPhone and the iPad right now. They have to make sure the user experience is absolutely perfect, and then they have to start placing ads in the mobile feed. But when thinking about a window, it's not years, it's months.
So they have the ability to internally fix their mobile problem. They don't need to go out and partner or buy somebody to gather intellectual property to fix their problem?
Well, I would say that they can do it organically without a partner or intellectual property. What they do need is to continue to aggressively hire engineering talent toward this end. And they are doing that. So they are very aggressively hiring engineering talent to improve the mobile platform, to improve search functionality. So yes, it can be done internally, but they are going to have to continue to source talent from the outside.
Anupam, I want to get your thoughts here on the fact that they bought Instagram prior to the roadshow for $1 billion. Did that not surprise you? Is that not something we should be looking at in terms of, what are their growth opportunities? Because when you look at some of the other devices up there like Snapchat, GIF Boom, are they going to need to be out there buying up all these other smaller companies?
Well, I think inorganic growth opportunities are going to continue to be part of the strategy. The fact that they acquired Instagram in and of itself is not a very big surprise to us. What was surprising was the overall price tag. So it is a very large price tag. But Instagram does bring a couple of things to the table. First, it brings a very passionate audience that's very, very important in social media. As sites like Facebook become very, very large, you lose that kind of, cool factor, when you, your mother, and your grandmother are all on the platform at the same time. They also bring a nice mobile element to it as well. So strategically, it makes sense. The question around the price tag is a little bit concerning, I think, for us from an investment perspective. But I think that when you think about the growth opportunities, they are going to continue to acquire small companies and small functionalities over time.
All right, speaking of concerns from an investor point of view, how do you feel about Zuckerberg's control even after it's a public company?
Well, I think it's two sides to the coin here. On the first hand, this is a company that he built in his dorm room. He wants to keep control, and I think that was widely expected. So I don't think it was a big surprise that he's going to maintain control. We have seen that with a lot of other CEOs in the social media and internet space that have gone public. In fact, that have gone public a while ago because Google just did a new kind of capital structure that they're going to keep control, Larry and Sergey. So I don't think that is a concern overall in the sense that it wasn't a big surprise. The one thing I will say about this management team versus some of the others that we've seen go public in the last 12 to 18 months is that there is a belief that Mark Zuckerberg, in fact, is able to hand over parts of his portfolio that he's not comfortable with to other members of the management team. So he's content to let David Ebersman run the finance function. He's content to let Sheryl Sandberg run the day-to-day operations of the company. And we view that as a great positive because even though he's got a big control stake in the company, the majority control stake, in fact, he's not necessarily viewed as the quote-unquote imperial CEO.
Are there any emerging social media companies that are going to nip at the heels of Facebook?
Well, it's already begun, like we were saying a couple of minutes ago with respect to your earlier question, you can never discount competition. So already we're seeing, the rise of Twitter, we're seeing the rise of Google+. So there are going to be other players in the space, and then you're going to get some category killers. So, Pinterest is rising very fast. You're seeing other kind of, professional websites. LinkedIn is obviously doing very well. So there could be category killers, there could be lots of other competition. We like the idea that Facebook is investing in its platform, it's continuing to improve its services, but you always have to keep an eye out for the competition.
Aside from valuation, what do you think is going to be the major pushback on this deal?
Well, there's a couple of things. I think first, we touched on it a couple of minutes back on the mobile side. Mobile monetization is very, very important, especially in an environment where we have seen revenue growth slow quite substantially in the first quarter of this year. The second thing is that investors are going to want to see some evidence that Facebook can monetize markets outside of the English-speaking world. Right now, most of the revenue is from the US, and the revenue that's not from the US is from the UK, it's from Canada, it's from Australia, etc. So they want to see monetization in non-English-speaking countries. I think if they can satisfy investors that those two are moving forward, then I think you could see a valuation toward the high end of the range.
Anupam, thank you so much for joining us today. Great recap for the first day.
Thank you very much.
Anupam Pallett, Senior Managing Analyst for Greencrest Capital. And after the break, are energy-rich provinces hurting Canada's manufacturing sector? Saskatchewan Premier Brad Wall weighs in on that debate. That's right after the break. Stay with us.
NDP leader Thomas Mulcair says that other provinces are paying a high price for the prosperity enjoyed by natural resource sectors like Alberta and Saskatchewan. He called it the Dutch disease. That was when natural gas was discovered in the 1960s, resulting in a rise in currencies that thought to have collapsed the manufacturing sector. Our next guest says that natural resources have in fact been the cure, not a disease, to the Canadian economy. For his take, we're joined by Brad Wall, Premier of Saskatchewan. Welcome to the show, Premier Wall.
Thanks, great to be here.
Well, let's get right to it. Can you talk about the tweet that went out that actually was the catalyst for having you on our show and your response to Mulcair saying that you are causing the Dutch disease of Canada? Well,
sure. Well, first of all, it's a tenuous economic construct, and here's why. You can almost see a mirror decline in the manufacturing sector in the U.S. Rust Belt, in states like Ohio and Michigan. with the Ontario decline, with the Central Canadian decline, which obviously is very unfortunate in both of those regions of North America. But it's a very similar decline, informed most likely, as if you listen to economists, a lot of economists, by a worldwide recession and changes in terms of manufacturing strength, shifts to other regions of the world. Why would the decline have occurred in those states in the U.S., for example, where there is no natural resources to blame? My point is that, first of all, this is a very divisive comment. I think it lacks some economic strength as an argument for the reasons I've just mentioned. And you know, there are social programs in this country that depend on fiscal federalism, that depend on equalization payments. We were a have-not province. We're grateful now to be a have province, but when we were a have-not province, Saskatchewan received indirectly or on a de facto basis, received help from other regions of the economy through a federal program that helped us sustain programs. The same happens today. We're a have province, happy to be net contributors, and in places like Quebec, where they need about $8 billion in equalization that help support social programs, that help, by the way, keep tuition rates more affordable, or at least at a lower rate there than many other parts of the country. And the same is true for other provinces, Ontario and others, who need that help. That is one of the features of federalism. It works quite well. The final point is this: when there are jobs available in one part of the economy because the economic engines are firing on all cylinders, as has happened in central Canada for many, many decades over the years, that's good for the rest of the country because it creates opportunity for other Canadians. That's what's happening in the resource sector, in potash and oil and gas and uranium, and it's a strength of our country right now. We ought to be proud of this resource, and some are seemingly, including Mr. Mulcair, seem ashamed that we're energy powers. Well, it's a good thing for the country, and I don't think you can blame the energy sector for what's happening in the manufacturing sector in parts of North America, not just Canada.
I'm totally in your camp, Premier Wall. I just hope that Canada can capitalize on the resource that we're blessed with, and that's a concern that I have. Can the powers to be across the country get their act together so that we can, in a timely fashion, build the infrastructure so as to benefit from the demand offshore of Canada and away from south of the border to sell our resources to?
We need to diversify those export markets. There's no question about it. Saskatchewan is the second least dependent on the U.S. for exports, and even at that, we're 60% dependent. We would like to diversify. We're working with those fast-growing economies of the world in terms of trade missions, in terms of a presence in those particular economies. We do think it's important to be able to get what we have to the coast, to those economies. Right now, the fastest economies in the world want two things. Well, the top two things anyway they want, I think, is energy security and food security. Imagine how well positioned this country is in a world like that. I like Canada's chances. I like Western Canada's chances in that world, but we need to be thinking about the future. We need to be able to get those goods to those markets, and I agree with you. I hope we see certainly environmental rigor that goes into the assessment of some of these projects. I think we're talking about pipelines certainly on that list, but once it has met the test of those environmental rigors, then let's get on with the business of being an economic leader in the world that wants what Canada has to offer.
Now, in the pending BC election, my understanding is the NDP are on record as saying if they get elected, they will vote Gateway down. That clearly would hinder your goal.
Well, I want to be careful about getting into politics in some other province. The other issue today with Mr. Mulcair is a federal issue, and so certainly we'll work to defend the interests of the West and what we think are Canadian interests in that debate. I would say, though, there's a trend here, because just that last week in our province, we had a debate in the House about Keystone in our Legislative Assembly, and our opposition, who are NDP, voted against a motion that simply said we support the project. The project, that Keystone project, is important to Saskatchewan. 25% of the oil in it at any given time can be back in oil, where we have pipeline capacities in that back in play in North Dakota, Montana, and Saskatchewan, and we need to be supporting projects that relieve that capacity so we can continue to create jobs, pay into equalization, support programs in other parts of the country, and offer employment opportunities for Canadians from coast to coast to coast. So there's a trend here developing amongst some of the parties in this country that I think that are risks to the Canadian advantage that we have going forward in a world that wants, as I say, what we have.
Premier Wall, I want to shift the topic a bit and talk about Viterra. Are you upset that they decided to sell themselves as opposed to try and build a kind of global powerhouse from within Canada?
Well, as we said during the potash issue, I think Canadian champions are a great thing to have. As you know, as a result of this deal, especially with one of the players, very much a Canadian company, they're building their capacity. And so when it comes to grain handling, notwithstanding how the Investment Canada decision comes down on this particular deal, we will have, on a de facto basis, Canadian champions in the grain business, in the input business. We're watching it very carefully. We've commissioned a third-party report. We'll receive the report today, and we'll look at it carefully and then make our public position known. We're seeing that there's an interest from a provincial perspective in relocating some head office jobs that had gone to other parts of Canada back to Regina. We're seeing an interest in expanding and investing in grain capacity, grain handling capacity by the new co here in the province, and also by making it its North American headquarters. So there is there's questions that we're still asking and analysis we're doing, but these are Saskatchewan priorities in the context of the takeover, and that's how we'll make our final call.
Do you think that Canada has the right policies in place really to become more of a global leader on the commodity front? Does everything, especially with the attitudes that we're hearing today?
I think the policies today are right, because as we see the federal government's moving to one project, one assessment. We have a federal government that I think does embrace the fact that Canada is an energy power, an emerging energy superpower. That's a good thing. And we have provincial governments, I think, who understand that we're also a world power in terms of food. I could run you down the list of things that we grow in biblical proportions in the province, and obviously the 53% of the world's potash is a part of that story. And the debate that's happening around it is healthy. We should have it. No one's arguing about it, but if a certain side wins, and that side is all about curtailing that growth, in the name of what, I'm not sure at this point, because a lot of it's not based on the environment, for example, in my view anyway, then I'm a little bit worried. We have a great opportunity as a country to continue to be an economic leader, and not to be a stuck record, because we've got what the world wants in terms of energy security and food security, and we ought to act like it. That means being responsible from an environmental perspective, but it also means stepping out in leadership, making sure we can get those goods to market, engaging with the rest of the world that wants these things. And I'm very hopeful. I'm an optimist. I think that's happening in the country and will continue to happen.
All right, Premier Wall, thank you very much for joining us on Market Sense today.
Thanks for your time on Market Sense. Have a good one.
All right, that was Brad Wall, Premier of Saskatchewan.
On the program tomorrow, we speak with David Garrity from DVA Research to get his take on the Facebook IPO and his top picks in the tech sector. We'll also speak with Keith Wirtz, who oversees $15 billion as Chief Investment Officer of Fifth Third Asset Management, so stay with us for that. Still ahead, a look at what is making headlines in the global marketplace. That is when we return.
It's time now to see what's making headlines in the business and financial markets globally. Let's go around the world in 80 seconds. Let's get it started off in Germany, where there are more signs that Europe's largest economy is weathering the debt crisis. German factory orders rose more than economists forecasted in March. It was boosted by demand from outside the euro area. German companies are beginning to tap into the faster-growing emerging markets as Europe's sovereign debt crisis has curbed domestic demand. Come with me now to the Kremlin. This is where Vladimir Putin took his oath of office to become Russia's president for a historic third mandate. It was placing his hand on a copy of the country's constitution. Putin swore to, quote, respect and protect the rights and freedoms of the people, yet activists accused Putin of having sacrificed those rights in the pursuit of stability throughout his 12-year domination of Russia. Let's go now to Greece. That's where stocks fell the most in 3.5 years. It was after the country's two main political parties failed to achieve a combined majority in yesterday's election. The New Democracy and Socialist PASOK party are 2 seats short of the 151 seats needed for a parliamentary majority, and its voters flocked instead to anti-austerity parties. Let's end it off in India. This is where government officials in New Delhi are saying the country plans to cut its oil imports from Iran by 20% this year. Asia's third biggest importer of crude is going to curtail its purchases from the Persian Gulf to 14 million tons from 17.5 million. Secretary of State Hillary Clinton arrived in New Delhi today, and she hopes to urge Indian officials to further assets to U.S. to pressure Iran over disputed nuclear programs. That is what's happening around the world in 80 seconds.
On the calendar of events is actually one of the more quiet weeks that we've seen as of late, but a couple of items to point out. On the economic front, we do have Canada housing starts, and also importantly, we've got German industrial production numbers. This is absolutely key given the fact that we continue to look at the situation in Europe and continue to have many concerns in terms of the growth there, so that will be very well watched. Also important to point out is China's trade balance. The reason why this is so important is because the outlook for China just over the past couple of weeks has brightened a little bit, so we're going to take a look and see what those numbers look like. They're also going to have their CPI, which I don't have up on the board right now, but that's also going to be important because that'll give us some indication in terms of how much room they have on the monetary policy front. Moving back to the North American markets, in particular the Michigan confidence numbers, once again, we're going to be looking at that in terms of how the U.S. is faring on the consumer confidence front. So we'll keep our eyes on that. As far as the earnings outlook, we're actually kicking off the end of the earnings season with a couple here. George Weston, the bottom line consensus number is 86 cents there with 1% revenue growth. We've also got Walt Disney reporting. Tim Hortons, keep in mind we just talked about this earlier in the show, that hit a 52-week high, and then Priceline, a stock that has and continues to do very well. In terms of today's take, Randy, I'll start with you. What do you take from the market moving higher in what looked to be potentially a very down day?
Yeah, this is the bad news equals good news mentality of the market, because there's no question what happened in Europe is bad news. It easily shows that austerity is something easy to talk about, really hard to force on people, and if you're a politician, it's the quickest way to the exit in the golf course. I think this is trouble. Europe's back in the headlines. Key word going forward is Europe, Europe, Europe.
Given the volumes were light today, I think that it shows how negatively positioned fast money was going into the weekend. And when the futures ended up turning positive this morning after being very negative overnight, I think there was a lot of covering, and that kept the markets in the green today, even though you're right, it should have been red.
The lesson we've learned is that when there is bad news that makes you think that the only solution is to throw more money at the problem, you get in the market and you win because the market's gone up. At one point, it's not going to work. This might not be the point, but one day people are going to get burnt doing that.
And I think it was a little bit more of a liquidity crisis last year. This year it's more of a growth crisis, potentially. And that some of these consumer stocks and some of the company specifics can continue to work, and we're seeing that in the marketplace.
And what folks need to watch this week is China. It's going to be all China later this week.
Thank you for watching. Have a great night, and we'll see you tomorrow.